What if the real crisis isn't lurking in the shadowy plumbing of the financial system or in China's crumbling real estate empire, but right in the heart of the AI revolution where millions of Americans have staked their wealth, their jobs, and their financial futures? Because while everyone's chasing the next big tech boom, Oracle just exposed the ugly truth. Their cloud sales bombed, capex exploded to $50 billion, and their stock plunged 13% overnight. That's the most in 24 years. Now, this isn't just a blip. It's a perspective-shifting warning that the AI hype could implode. And when it does, it'll wipe out jobs and crater the markets. Now, stick with me because I'm going to show you how to navigate this so you don't get caught when the AI bubble bursts. Now, plus, back on Friday, my CTA Timer Pro subscribers, they nailed that trade on silver, cashing out a cool 11.69% gain in just under a week. Now, if you're ready to rake in gains like that, no matter which direction this market goes, grab those links in the description below. Use a coupon code for your free 30-day trial. Stay tuned to the end of the show for more information. Because let's dive right in. Oracle's fiscal Q2 earnings report, what did they find? Revenue up 14% to $16.1 billion. And that's pretty good on the surface. But their cloud sales, the heart of their AI push, grew 34% to just under $8 billion, shy of what Wall Street was expecting. But get this, infrastructure jumped 68% to just over $4 billion, and that's thanks to deals with OpenAI and Metre. But the bookings measure, the remaining performance obligations, hit a whopping $523 billion. Sounds big, right? Because here's the escalation. Capex soared to $12 billion. Free cash flow went negative $10 billion, and his debt now sits at over $106 billion. And analysts are freaking out about the delayed payoffs from these AI data centers because it's taking longer to turn these investments into revenue than they were promised. And that's the biggest question now on Wall Street. When will this massive spend on AI turn into real profits? But let's be clear, it's echoing the dot-com bubble nightmare all over again. If you remember back then, investors poured trillions into internet dreams, only for the bubble to pop, wiping out fortunes overnight. But it wasn't just paper wealth that vanished. Companies crumbled, jobs evaporated by the hundreds of thousands, and it took years to claw back. In fact, 6 years of stock gains were erased in just a blink of an eye. So it's not just Oracle that's stumbling, it's the economy screaming canary in the coal mine that we could be facing one of the biggest bubbles since 2000. Because if this AI facade cracks wide open, we're talking widespread tech layoffs and a market meltdown that's going to drag your 401k and the economy with it. Let's dive in. Now, Oracle's cloud mess isn't just some standalone glitch. It's a glaring symptom in the entire AI sector overhyping breakthroughs without the quick revenue wins to back them up. Now, they affirmed $67 billion in annual revenue guidance, but they raised their capex by $15 billion for data centers alone, and this is all betting big on OpenAI's needs. But OpenAI is facing its own code red from Google competition, and Oracle's reliance on them, half of their backlogs are tied to them alone. That $523 billion of contracted future revenue is screaming nothing but risk right now. Their stock was down 13%, their bonds are tanking, and their credit default swaps are sitting at 2009 highs. And what this could do is it could drag down the NASDAQ, which has already been quite volatile, and ripple right into the S&P 500. Now let's take a look at some broader market fallout, because Oracle's woes have ruined the cross-asset parity post-Fed cut, with traders now flocking to treasuries and gold. And this has investors wondering, is the Fed really just cutting and bringing back QE? Now remember, it's called reserve management purchases to deal with the liquidity issues, or are they really concerned about the underlying economy, the labor market, and the risk if the AI bubble bursts? Because underneath, financial conditions, they're continuing to tighten even after the Fed cut rates. And we could see this as evidence in two-year treasury yields. Because the yield on policy-sensitive two-year treasury yields tumbled almost 8 basis points after the Fed's decision, making it the largest one-day slide in 2 months. It fell another 1 basis point on Thursday and during Asia's trading. Now let's be clear, when yields lead the Fed lower like this, it's a red flag that money's getting scarce. It tells us that banks are hesitant to lend, and that means delinquencies are likely to climb. And that one rate cut next year? Not likely. There's going to be a whole bunch, and they're going to start early next year. But not everyone's buying the calm narrative. Sure, some experts like Kenny Polcari, a chief market strategist at Slatestone Well, he thinks, I don't think it's a canary in the coal mine. And he's not surprised by the reaction given the run-up in tech stocks this year. But the market begs to differ. Because right now, Oracle faces its own code red AI moment. Because investors are starting to ask the two most important questions. Just how much all of this is going to cost, What happens if its cornerstone customer, OpenAI, can't pay? And on top of that, you look at that $105 billion in debt Oracle has, and it will probably need to borrow tens of billions of dollars just to compete with other companies, a level of capital intensity that Oracle shareholders aren't accustomed to because they're used to massive profits. Now, the issue is the market doesn't think OpenAI can pay, and that's going to leave Oracle holding the bag. And this is why Oracle's credit default swaps have jumped compared with investment-grade peers. As far as the stock, we're talking it's down over 40% from this year's peak. And again, that's a sign that the market believes that Oracle may have to issue shares, and lots of them, to pay on its debt. But this isn't just Oracle, because what this exposes is the AI arms race dark side. Now, OpenAI, they're a heavily loss-making startup whose early AI lead no longer looks unassailable, and they have declared code red as well. And for good reason. And what is this nuclear arms race of AI? Google's Gemini model is now winning rave reviews. But that's just today. Tomorrow, it could be another AI that takes the lead, and with that, even more spending to play catch-up. And while all the players agree that more spending is needed, there's one thing nobody seems to have an answer to. When do you run out of money, or when does this thing start generating a profit? Because after decades of profit, net dividends, we're talking Oracle's year-to-date free cash flow burn is now minus $13.2 billion, which is modeled to get even worse to a negative $28 billion by the end of this fiscal year. And here's the kicker. Oracle is going to be forced to keep borrowing as its debt balance grew to $108 billion from $91 billion last quarter. And its cash balance, well, it's just merely increased from $10.4 to $19.2 billion. What that means is they don't have enough cash to make it to the end of next year. And with this capex surging to $50 billion, they're going to need a substantial amount of money by year-end 2026 just to survive. And this is where we come all the way back to two-year treasury yields, tightening financial conditions, and why Oracle's credit default swaps are blowing out. Because let's be clear, when interest rates are leading the Fed lower, again, it's a sign that money's getting tight. Banks are going to be apprehensive about lending. Delinquencies are going to rise. And here's the key point. It tells us the labor market is weakening. Let's take a look at some of these warning signals, because this next chart of two-year treasury yields in blue against the NASDAQ 100 in red clearly shows that falling yields are the biggest red flags for stocks. Let's go back to 2000. You can see yields led the market down. You can see it happen again going into the global financial crisis. Now, it didn't happen around late 2018 into 2019. There's a reason why. I'll show you that in a minute. But look at what we're facing now. Yields are going down. Stocks are going up. Investors are betting this is 2019 again. But there's an underlying issue here. It isn't. So what you can see in this chart is exactly what we're seeing with Oracle's stock price and its credit default swaps. Because the market isn't confident that Oracle will be able to get the money it needs next year and the years after that. But this isn't just a warning for Oracle. It's a warning for all tech companies that are spending big. And on top of that, they're having to lay off just to keep up their spend. And as jobs disappear and money gets vaporized by debts, this liquidity problem that the Fed's trying to fix is only going to get worse. Because in the end of the day, it's all about the labor market and the ability for companies to service its debt. Let's take a look at this next chart of the unemployment rate in blue versus the NASDAQ 100, still shown in red. And I want you to see when workers lose their jobs, let's be real, these tech companies are going to have to keep laying off to fuel their capex spend. You can see the stock market goes. It's very clear what happens in 1990. The unemployment rate shoots higher. Next thing you know, what happens? The stock market crashes. It happens again, dot-com bubble. You see it during the global financial crisis. And why didn't it happen in 2019? Because the labor market remained resilient. This time, it doesn't look like that's going to happen at all. So now we see very clearly the bottom line, it's all about the labor market, and we can already see it's likely to get worse going into next year. Because again, this isn't 2019 again, but investors, they're acting like it is. They're buying every dip, every rate cut. But Oracle, it's a warning shot, because if financial conditions continue to tighten, and more importantly, the labor market breaks, and again, I think it's going to in the first quarter of next year, you can see we're setting up for another dot-com style crash. Now, we've unpacked the Oracle bombshell and its escalating ripples. Let's wrap all this up into the payoff, because this isn't just doom and gloom. This is your wake-up call to act before the AI bubble potentially deflates even further. Now, let's talk about the risk ahead. We're facing a deepening cash burn across these tech giants that could trigger widespread layoffs, tighter credit margins, and a NASDAQ correction on the mild side of 10 to 20% if yields keep falling while the unemployment rate ticks up. But if OpenAI or similar players falter, Now you're facing Oracle's $523 billion backlog, turns into a debt trap. That's going to amplify economic slowdowns, and it's going to hike borrowing costs and erode job security. And the next thing you know, it's going to be 2001 all over again. So what should you be watching closely? Now, keep an eye on 2-year Treasury yields. If they fall below 3.5%, that liquidity crunch, it's real and it's not stopping. You want to monitor weekly jobless claims. Anything over 250,000 initial claims is telling us their labor market is weakening and fast. And you want to track upcoming tech earnings like Microsoft's in January, because another cloud miss, that could ignite panic selling. And if you're trading this on the long side, and mind you, buyers are stepping in on every dip, watch the 30-day volume profile, particularly on like QQQ. This is your line in the stand. This is your key support level. Set your stops there. Because you want to rent this rally. You don't want to own it. You want to use it as an opportunity to diversify out of your vulnerable consumer stocks. Trim your retail and discretionary holdings by around 20 to 30%. And use this to pivot in defensives like utilities or healthcare. They hold up in downturns. And remember, Jeffrey Gundlach, he's the bond king. We've been saying over and over that he says boost cash to 20% of your portfolio for dry powder. Why? Because when companies like Oracle lose 40% off their peak, there's going to be opportunities to buy. Instead of cash, consider short-term treasuries that look to be long the dollar, but keep in mind, since the Fed rate cut, just as expected, the dollar's weakening here. You want to wait until it bottoms out and then look to add positions there. You want to hedge with gold or silver. We see gold up today. That's validation on that call. And when it comes to time the swings, look for proven strategies like my CTA Timer Pro report that nailed that 11.69% swing on silver in just under a week. In fact, we're already setting up for some of our next big trades, and I want to show you just how easy it is for you to make money in these markets, no matter which direction it goes. Now let's take a look at that trade on silver again. There's something notable here, is it had an expected win rate of 63%. Now let me show you how we do this. Every day we look at the machine position across the broad equity, bond, currency, and commodity markets. And all we're doing is very simply looking to position our subscribers ahead of a big wave of machine buying and get them out before the machines sell. But there's something we've done to take this to a new level. See, I know these machines trade based on threshold levels, but what we've done is we've optimized them and fully backtest them. So I know which threshold levels that trigger are going to put the most money in your pocket with the best odds. And that's the advantage of a fully optimized trading system, which you see here. Now, this is how easy it is. You're going to log in, you're going to scroll all the way down to the bottom, click on the latest date, and what are you going to access? Updates on our existing trades. You're going to get the new trades with full risk control levels. These are the ones that I put on my hot list, and then you're going to get every trade generated under our optimized system for the day. It's just that easy. You get all the tradable signals. You get my opinion on the best trades, full risk control levels, of tracking of all open trades and returns, a weekly update, and here's the best part of all. You get a 30-day free trial, because that's how confident we are in our system. Whether you're new to trading or experienced trader, you can find out why we're the best. All you have to do, grab those links in the description below, use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.